Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Todd Dexheimer. He began investing in real estate in 2008. Today his companies own $500 million worth of multifamily, senior housing, and commercial real estate. Todd has completed over 150 flips, including 20-unit mobile home park and a ski resort. So thanks so much for coming on today, Todd.
Yeah, absolutely. Appreciate you having me on.
So give us a little background on yourself before you got involved with real estate investing. I know you had a actual full-time W-2, and then how you made the transition to real estate.
Well, before I got started in real estate, I was a high school and middle school teacher. I was teaching technology education or industrial tech, and teaching wood shop, metals, welding, automotive, all architecture, engineering, all kinds of stuff like that. So it was a lot of fun at times, but also just some things I didn't like. Mostly the politics within the school. You know, you had to do certain things that just were a waste of time and energy and effort, and then they would switch it up the next year or the next 6 months later. No, never mind, you have to do this process, and it's like, all right, you guys are ridiculous. So anyways, I I did that for 5 years, and the last year was a part-time year. Worked out really well. I was able to go part-time teaching, and then really focusing on real estate. And it all started really with reading just some books. I was just kind of bored at night. And so I'm reading some real estate books, and I'm not a big TV watcher. Pounding a bunch of real estate and entrepreneurial books. And I'm like, this is what I could do. I could do this real estate thing. So that's how it began.
Nice. So when you were starting, when you're starting out, was there anything other than you start reading books? Was there anything that kind of had you choose real estate over another, I guess you'd say, investment vehicle?
I would say familiarity with and comfortable, right? So I worked construction through the summers for really what I got. The first year I got out of high school, I was working for a remodeling company, and did it, every summer worked for a remodeling company or the same remodeling company. And even when I was teaching in the summers, I'd work for that remodeling company. And then I'm teaching about, kind of construction and different things like that. So I would say maybe just that familiarity. It felt pretty natural to be able to run the numbers and analyze it, and just feel good about it. But no, I didn't have family or really friends that were really doing it to that extent. So
yeah. Did you start off flipping houses first before getting into the other asset classes that you guys focus on now?
So I first started out doing all kinds of stuff, and literally, my first transaction was really 3 purchases. I purchased a single family home that my wife and I lived in, and we were renovating while we while they call it a house hack or whatever they call it right now. So we were living in it. We were renovating it. It was a foreclosure.
Wow.
And we ended up, I guess, slow flipping that. I bought a rental house with pretty much every last penny that we had in savings. And so we bought a rental house that we renovated and started renting. And then I bought another house with a partner who funded that deal. And that was a flip. So
Nice.
kind
Wow.
of started out. And literally, Charles, like, I don't remember which one I bought first because they're all within probably a couple of weeks of each other.
What was your meaning for kind of switching from flipping houses into getting into more rentals, whether they're single families or multifamilies?
Yeah, I never wanted to flip.
Yeah.
I flipped a lot of houses. I flipped like 150 or so. But that was never my intention. My intention was always to buy rental properties. My intention was very early on to buy apartment buildings. I just didn't know how. And so I had not only I had limited beliefs, but I also had limited experience, limited capital, limited connections. And so flipping was the natural and made sense. And quite frankly, it was a great time to flip. I was good at it. And so I had the construction background and all that kind of stuff. So it made a lot of sense. So flipping just became something I did and I enjoyed and I was good at. And eventually I was just like, okay, now I'm burned out and let's transition and start doing different things. But by the way, at the same time, I was flipping. I was also growing a rental portfolio, but it was mostly like 1 to 4 family properties, a couple of small apartment buildings. But then that transition to multifamily happened really because I was just kind of like, I'm done. I'm done. Like I'm kind of burnt out. The market had also shifted differently. You could still make a lot of money in it. This was about 2014, 2015, but the market had shifted quite a bit. Foreclosures really weren't raging, and so you had to approach it differently. And I just didn't want to switch, and learn, I guess, the new strategy.
So tell us about your first multifamily real estate investment when you were kind of going into larger properties. I mean, how did that turn out and what did you learn during that process?
Man, I mean, I could tell you about several different ones, but I think I'll tell you about my first kind of biggest one. And I actually bought 2 properties pretty close to each other, a fairly close time frame there. And they really worked well with each other. But so the first really one that I bought that was a syndication, that was an 84 unit building. And man, what did I learn from? I learned so much from it. So I went full cycle on this asset completely, which and it ended up working out pretty well. We made it a decent amount for the investors. I made a decent amount. Everybody ended up in the end pretty happy, but there was a lot of learning lessons along the way. First lesson is that, well, first thing I took out of it is I no longer will buy a C-class asset. C-class locations or C- probably locations. It just, to me, there's too much risk involved. When a recession happens, it's the first to go down. It's the farthest to go down. It's the last to go up. I don't care what people tell you that C-class is going to be great during a recession. It never is. It never has been historically. And so I don't know why it would all of a sudden change magically overnight. It just won't happen. And so anyways, so that was something I took from it. It also just didn't do the best due diligence. I didn't hire the right professionals. So for instance, we didn't do full sewer scopes. We didn't really truly inspect the plumbing lines as well as what we should have. I didn't hire a professional inspector plumber or plumber to look carefully at those and determine the life expectancy of the plumbing. Same thing with the roofs. I hired a roofing company that was actually a long story, but was hired by the property management company I was going to use, who was actually the current property management company on the property. So that's a
Oh, yeah.
so they lied completely about the roofs. So a couple things went wrong. We had to replace all the roofs day one.
Wow.
Now the good thing is we budgeted for most of the roofs. So that was okay, but I didn't plan on doing it like right away. And there was a lot of damage, like literally day one we closed and it's raining out, I think by day two, and we've got leaks. I mean, units being flooded by water.
Wow.
That's how bad it was. And they covered that all up during the due diligence walks. And so there's things like that, that's another mistake. And unless you know the property management company that's currently managing the property and they've got a great reputation and they've been managing your current assets, or you have a good reason to use them, don't use the current property management company. Or be very careful with that. And so that I would next, or I have not done that again. And I would just be cautious about doing it if I were. So this management company was owed money by the previous owners, and they covered a bunch of things up. They hid a ton of things. And so we were, kind of caught with our pants down, for lack of better terms. They also fraudulated the books, all kinds of stuff. Now we caught them for some of that stuff. We decided not to use them, hired a different management company. We had some seller credits that we were able to put in place because of the fraud. But it was just a kind of a mess. So lots of lessons learned, man. I got so many more, Charles. I don't know how many you want me to go through. But I'd say the most important lesson is just thorough due diligence, and just really pay attention to what you're getting into. Because some of these things that happen to us along the way probably just were unavoidable. And that's just what happens. Like you couldn't have predicted. For instance, we had a plumbing pipe, under the ground, 8 feet underground, that ended up bursting and flooded 4 units like that. I don't think we could have predicted. We also had a gas line rupture underground. That again, we probably couldn't have predicted, but some of the other stuff we definitely could have if we would have done better due diligence.
When was this property built approximately?
Well, that's the other thing too, is so if you're going to buy buildings built in the 1970s or earlier, and this was 1972, I believe. So if you're in the 1970s or earlier, you want to make sure that you really have a heavy plumbing budget, and a heavy HVAC budget. Those are two major things, like major items that go wrong in these buildings. And I don't care, like time after time after time, unless it's been redone, time after time after time, the plumbing and the HVAC are a huge mess, and you have to budget for them. So now we still will buy a 70s built asset if it's in the right location, but we are looking carefully at that plumbing and HVAC and everything else. But we are taking our budget and what we think it'll cost and doubling it.
Yeah. There's also like a lot of other things too there that you get. We just sold like all of our older properties within the last 6 months. And it was like, stuff you have in those properties are, you have you have lead, possibly asbestos, aluminum wiring. I mean, there's tons of stuff when you start venturing older than 1980, let's say. And it just, like you said, you just have to budget for it. And a lot of people don't. And a lot of people are buying, like you said, C-class properties, which they haven't been maintained like you'd be buying a B-class property. They're just not, because it's just it's not feasible, and they're everybody's trying to sell their stuff at the top of the market, or get money from stuff. And
well, Charles, I mean, what happens, right, is you buy an asset, you go, okay, what can I do to increase the value? Well, it's everything surface level. It's what my residents are seeing. You're not replacing plumbing pipes because the residents don't see that. So you're just patching You're just putting
Yeah.
band-aids on an issue. And these plumbing pipes are they're older pipes that have a life expectancy of 40 to 50 years. And guess what? That's over.
Yeah.
And so you are just sitting on a potential disaster, and hopefully you get out in time before that disaster ends up coming to roost, because it's going to be somebody's problem one of these days. On all of these properties, it's going to be somebody's problem.
Yeah.
And
It's crazy. I had like years back, I had this small commercial property, mixed use, and we had this leak coming into the basement, and one of my plumbers opened the wall, and the person had connected 2 copper pipes with flexible, like you would use for an outside fountain pipe, with like the little like screw pipe clamps or whatever. And you're just like, what are people thinking? And had to go in there. Well, it's just like the amount of shoddy stuff that gets done in these properties is overwhelming. You know, it's just, it's crazy. So you really have to be diligent into that. And really, it's a different due diligence process for a 70s or older property versus maybe a newer property where your mechanicals and your roof are more recent, and there's, you're using newer electrical and stuff like this. So
yeah, and you got newer, you got the newer systems, so it's easier to, even when you do have to do repairs, it's just easier. We don't have to. Now, not always. I mean, there's some things to look out for, like polybutylene piping, right, and things like that. But for the most part, if I've got copper piping, I can either attach new copper piping back onto that to fix the leak, or I can put a PEX type piping, and it's easy. It's not a problem. Where if I'm dealing with cast and or lead or just a mess.
Yeah, exactly. So tell us about, like, you've done some like very creative financing over the years. And I think one of them that really piqued my interest was 120 unit building you bought was 8% down. So tell us about like how you found this property, and how you were able to get into such a great deal position on it.
Yeah. So I told you about the 84 unit. This was a 120 unit that was really close to that 84 unit. And how I found that property is I had the broker that sold me the 84 unit. I said, look, it's not big enough. I need more units, and I want something really close by. Why don't we just call all the neighboring owners and let's see who wants to sell? And that's exactly what they did. This guy wanted to sell, or was ready to sell. And so we negotiated the price with them. But at that time, I'm like, look, I don't want to do a bridge loan, and this needs, renovation to it. And so, my offer was, paying his price or very close to it, but he's going to finance this property, seller financing. And, instead of paying him this big down payment, what we're going to do is we're going to take our renovation budget. Okay. So we're setting up like a bridge loan. We're setting up like a construction loan. So we're taking our renovation budget, we're putting it into an escrow account that we can access, but in a draw process. So as renovations get completed, then we can pay it out of that account. Now, if we default, then he gets to take whatever money is left in that account that hasn't been drawn upon. So he gets that money. So we set actually part of the not the entire renovation budget actually, but we set a big portion of the renovation in this escrow account. We gave him a small down payment, and then we kept some working capital to, pay contractors some money up front, or get materials and stuff like that. Wow. And so that's how we set the deal up. It was all seller financing, no bank involved. We also did an entity exchange, and it worked out great because it was still seller financing. And so that the entity exchange worked out good. So that allowed us to not have the change in taxes due to the purchase price. And that property worked out really well. I went full cycle with that as well. Again, it's in the C- neighborhood. So went full cycle and then ended up doing really well on that one.
So before you go on, you talked about the changing entities, and that way you're buying the entity that owns the property. Is that correct?
Correct.
How do you, I've heard this, someone asked me this like last week, and I was like, you have to talk to your lawyer about it. It's a very complex strategy.
Talk to your lawyer.
How are you able to vet that this operating LLC is not going to bite you on the back end with liabilities you have no idea about.
Yeah. So attorney, vetted, just like they're looking at the property and the title and all that kind of stuff. They're vetting that LLC. But then when you close, you actually close, you purchase the LLC, but then you sell the LLC to a new LLC that you open up. And so that helps a little bit to potentially mitigate some of those, past skeletons.
Right.
But yeah, it definitely has a little bit higher risk to it. If you're buying in your own entity, it's good, but man, it really can help with some cash flow if your taxes are going to otherwise go up.
Yeah. It's a great strategy, but it's definitely an advanced strategy for everyone listening.
Yeah,
so speak to an attorney.
Have to have attorneys involved. Yeah. I mean, really anything we've talked about today, like you want to make sure you're having attorneys involved in all your transactions and syndications and all that kind of stuff.
So you've done a bunch of seller financing deals. What would you consider are the most important points that investors new to seller financing should focus on when looking for deals or speaking to owners and kind of getting them ready for seller, to do seller financing?
Yeah. That's a great question, because I think really seller financing is going to be coming back. Interest rates are skyrocketing. Sellers still want to sell, but they're going, man, I got this locked in at 3%, or they paid it completely off. And I really want to sell this building. So there's a lot of things you can do to get creative. One of the things actually we're doing right now, and then I'll answer your question. One of the things we're doing right now is with our syndications, we're actually, we say to the seller, look, instead of seller financing, because seller financing, let's just say we do a seller second. If I do full seller financing, no big deal, right? But a lot of times the seller doesn't want that much, that's a lot of risk on their end. So, or they have a loan and the lender, that just gets complicated to do seller finance. So they say, look, I'll do a seller carryback. I'll do a seller second for a certain amount. But what that does is that affects the DSCR, the debt service coverage ratio. And the lender will look at the second and say, look, we were going to lend you, let's say $5 million, but because of the seller second, we're only going to lend you $4 million. Because of the DSCR, because of the loan to value, that type of stuff. So here's what we're doing instead. We're saying, hey, Mr. Seller, we like this deal. We'll pay you, $5 million for it. But we want you to do a seller carryback. But instead of a seller carryback, we're going to actually offer you shares into our syndication. And we're offering you an A share class at, let's call it 5% interest. Okay. So it's an A share equity, 5% interest. And we treat them as an actual investor, and they show up on the cap table as an investor. So it's not a second mortgage. And so we then can get the full leverage that we wanted to on the property in the first place. So that's really complicated. Method for those of you who don't really understand what I'm talking about. Some people will be like, oh, that makes sense. While other people are like, what the heck is he talking about? So I'm happy to go in more detail or just talk to people sometime in the future, as they listen to this and they're like, what the heck is this guy talking about? But it's legal. Yeah. It's ethical. It's, it's totally okay to do, of course, again, with attorneys involved. But that's the way. So seller financing, look, the biggest thing why people don't get seller financing is because they don't ask. They just don't ask. They think they can't get it done with seller financing. So they just don't ask. We have every offer. Now we stopped this for a little time period just because the market got super hot and nobody wanted to do seller financing. But I think we stopped it in mid 2020. Okay. And then now we've started back up with seller financing terms. So every offer we make, we make two offers minimum. Okay. The one offer is us buying it with cash, bank finance or whatever, just giving the seller their money. The other offer is some sort of seller involvement, either the seller carryback, the seller equity, whatever it might be. And we show the seller what that financially will look like for them. Okay. And that's really important. So I don't want to just write an offer and the seller looks at it and goes, oh, what? I don't even want to think about that. No, I want to write an offer and I want to show the seller what they're making every single month. And then I want to write an explanation. Look, here are the advantages to doing this. The advantage is you're not paying taxes up front. The advantage is, you're getting X amount of dollars per month, every single month here, so we want to lay that out for them and then present that to the seller. And now you're usually dealing with brokers. So if you can get the broker to say the thing we like to say is, look, here's our offer. We would like to set up a phone call between you, ourselves, and the seller to explain what we're trying to offer here.
Yeah. I've always found it when there's a broker involved, an agent involved, the seller financing isn't delivered properly. It's just, It always dies. If I can go speak directly to the owner, that's when I can pique their interest.
Yep.
So that's a great way of doing it. And I like having the two offers too. I've heard that before. The other thing too, you said about having the shares, I had shares from the seller, into a new syndication. I had a partner 2 years ago that did that. And they were able to do it without any other money because they had the owner and they brought him on. And it was a syndication, really was just GPs and this guy is an LP, but they're also sharing on the upside, which I feel is like the best thing of everything. Yeah. Which is like one of the best things too with it is like what a selling thing, like, hey, you don't have to do any of this work, but you can like write out the majority of the value of your property with us on our team. And now it's, if you have someone that's, not 85 years old that wants to retire, it's like, someone is, will take that little trip with you, then it'll work, I think. So,
everybody's got a different motivation for selling. Yeah. Everybody's got a different financial need. So you don't know that for the most part going into it. So if they are represented by a broker, it's going to be tough to ask those questions. You certainly can, but it's going to be tough to get the answers. A broker usually is not going to dive into the reasons. And it's really hard to typically get to the seller, especially before you write your offer. So just don't assume that they will reject a seller financing. If you can get to the seller and you can talk to them, then those are some of the questions you ask. What are your motivations for selling? What are you going to do with the capital? That type of stuff. And, what are you going to do to avoid taxes? All that kind of stuff. And if you can get the right answers, you might go, okay, hey, look, we can formulate an offer that works for you and works for us.
Yeah. Interesting. Very interesting. So thank you for that. Just one thing here. I was when I was doing some research for this episode, and you've been involved with so many different real estate classes, and you said you would advise or never advise anybody, new real estate investors or potential real estate investors, to buy a duplex and become a landlord. Tell us why.
Well, that is maybe me just trying to say that to most people, right? Now, some people I would say that's go ahead, buy your duplex, buy your single family. That's good, but that is if you want to be a professional real estate entrepreneur, right? And so here's what I think is most people get into real estate because they think it's passive. Because they think it's a great way for me to have some passive income. I heard, I know people that have had real estate, blah, blah, blah. And they think that is going to be passive. And so what do? They buy a duplex or a single family house and they hate their life because here's what happens. You buy a duplex or a single family house and all of a sudden, 6 months in or 6 years in, the roof has a leak and you got to replace the roof. Okay. So that's, $8,000 or $10,000 now. And you missed out on a bunch of cash flow for many years because you're probably only making a couple $100 a month, right? You're making $200-300 a month. Maybe sometimes you're making less, right? So you're making a few $100 a month. And so $10,000 later, man, you're talking years to just recoup that. Well, the roof springs a leak. That's good. You got that replaced. But lo and behold, the furnace goes out the next year. Well, $4,000 later, you got a new furnace and you missed out on cash flow for another year and a half or 2 years. That's okay. You got that taken care of. But then all of a sudden, the refrigerator and the stove go out, and you've got to do that. And by the way, you had to evict the tenant because they didn't pay their rent. And so you got to get rid of them. But you were like just trying to be really nice because they're just nice people. So you gave them some leeway. So it has been 5 months since they've paid you. And by the way, they've got kids and they're not getting out. And so now you got to file a writ on them and you got to get the sheriff to come and actually get them out. So now 6 months later, they're finally out, but you go into the property and find out they destroyed it. And so you got to renovate it and spend $6,000 renovating. And you can't find a contractor to jump on it right away. So they finally get there. 10 months later, now you've got a new tenant in there and it's really, really working out well. So by the way, that's the true story because that's happened to me.
Yeah.
And so it's not passive, and it oftentimes looks great on paper, but oftentimes ends up not being. And you're like, this sucks. I hate tenants, toilets, and trash. And I'm going to badmouth rental properties because I thought I was getting in passively. If you look, most people that are getting it have a good job, doctor, lawyer, attorney, accountant, whatever, engineer, you name it, or a decent job, right? They get on, they have a decent job full time. They got kids. They like their free time. And then they hate freaking real estate because they thought it was going to be passive. And it's just not passive. It's just not passive. Oh, I'm going to hire a property manager. Well, guess what? You still have to manage that property manager. You still have work to do. And so if you're going to buy real estate and you want to be active, you want to be the entrepreneur, go ahead and buy the duplex. But otherwise, buy a bigger building with a group, with people that are doing this professionally, whether it's a joint venture, whether it's a syndication, whether you're just going to invest in a REIT, whatever it might be. I think that, to me, that is for the vast majority of the population. The 99% should be doing that. It's running and operating a business if you're going to do it, if you're going to do it right.
Yeah, no, it's exactly true. And the other thing too, going back to that duplex example, is that person's trying to save money. So they're managing themselves. So they're at that property twice a week, not getting paid for it for those 5 years. So it's an exactly correct example.
So many people think that their my returns though are so much better on my duplex or my single family house. Are they?
Yeah.
Because you forgot to pay yourself. You forgot to pay yourself for the maintenance, for the showings that you had to do, for the late night calls from your tenant, from by the way, taking some time off, some PTO from your work. You took time off that you could have done it as a vacation, or take some sick time that you could have used otherwise to go to the property during the day because you've got a full-time job, and you forgot to take all that into consideration. So let's pay yourself and then figure out what your returns really are.
Yeah. Your return on time. I mean, all these type of things, when you actually work it out, you're going to see, you're like, wow, I do make like $65 an hour at my regular job. And somehow I make $25 here, when I'm here, all this kind of stuff. So, but, so Todd, what would you say are the main factors that have contributed to your success over the years?
I think there's several things. I would say just taking action. Like it's so easy to dream about stuff and so easy to think about doing it, but taking action is that's the only thing that's going to lead to results. I think too many people fear failure. I'm definitely conservative. I'm definitely not out there writing a ton of offers on every single property and being aggressive. But look, you can't fear failure. You have to get beyond that belief of, well, what could happen if, what can happen if, what can happen if. I mean, it's important to think about some of those things, but then come up with a plan. And again, if if you can get over your fear, then you're willing, or then you're able to take action. So I think probably those two big things, taking action and just pushing beyond your fear. I mean, there's lots of other little things, we could talk about, but those are two big things, I think.
Awesome. Well, thank you so much, Todd. So how can our listeners learn more about you and your business?
Yeah. So, a couple different ways. I'm on mostly on LinkedIn and Facebook. So go ahead and connect with me there. Enduruscapital.com is our website, ENDURUS capital.com. My email is todd@enduruscapital.com. The last thing is I have a podcast also. It's called Pillars of Wealth Creation. And so would love to have your listeners, of course, after they're done listening with this, listen to my podcast as well.
Awesome, Todd. Well, thank you so much for coming on today, and looking forward to connecting with you here in the near future.
Absolutely. Thank you, Charles.
Talk to you soon. Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.